Hello, my name is Yale Simpson. I'm chairman of Exeter, and I've been on a number of occasions to give updates when we have something that's material, and certainly the news of today is very material. When you look at the company, and when we started Exeter in 2003, it was in 2005 that we took an option on this piece of land in Chile that's called Caspiche. It then was in 2007 when we got our first drill hole in it. It was drill hole number 13. That indicated the potential. In fact, for our geologists, they pretty well knew they were onto a winner with drill hole 13, and certainly by the time they got to drill hole 16. So it only took 3 or 4 holes before they realized that this is what we would call a world-class discovery. So between the discovery and when we picked it up, the option in 2005, and today it's about $50 million worth of work to get us to what we call the pre-feasibility level. Now this is a major study with one of the world's largest engineering companies involved in this study, and it leads on then to what we would call final feasibility studies, mine permitting, and then you go into construction. So we've taken significant risk out of the project today in releasing this study. The project has an ideal location. It's in a really active mineral belt, and that is so important, not only from the project development point of view in terms of potential to share infrastructure, but it's really important from an investment point of view. If you look at this particular slide, you will see a whole series of projects and mines from the top, which is one called La Coipa. And just to recap, in gray is in Chile. On the right-hand side, Argentina is the yellow color. So you see La Coipa, owned by Kinross. And then you can go down and talk Volcan, Lobo Marte, Maricunga mine. Then Caspiche, you can see the green square. And then moving on, Cerro Casale, Caserones, Tex project, Veladero then, Pascualama. And these are all major projects. On the left-hand side, you can see the sizes of these things, proven and probable reserves. And of course, Caspiche is shown in the yellow box at 19.3 million ounces of gold, 4.6 billion pounds of copper. Now, the important part is that these projects, if you say who owns them, almost universally, they are owned by major companies. They are not owned by junior companies. And for the most part, those major companies acquired these projects either by way of some sort of deal, it might have been a joint venture, or it might have been the acquisition, the purchase of the project, or the buying of the company. But it is very important that for the most part, these major companies did not make these discoveries. They entered into transactions. And in some cases, it was junior companies like Exeter doing a transaction with a major. So moving on, again, here's some more detail, slide 5 here, on strategic location. Now looking at a detail, you can see Caspiche there, but to the left, which is actually to the north, is a mine called the Maricunga mine. Now that is owned by Kinross, and it's been in production for some years. It's producing in the order of 225,000 ounces of gold a year, no copper. But it's in production for years. There's water lines, power line, road to it, significant infrastructure. And when you look to the right of Caspiche, you see Cerro Casale. Now Cerro Casale is only 6 miles, 10 kilometers away as the crow flies. Now this is one of the largest pre-development projects in South America. It's owned by Barrick and Kinross. And that project has gone through feasibility, and it's now in the final permitting stage with the government of Chile to get the green light to proceed. So Maricunga mine, 10 miles north. Cerro Casale mine, 6 miles south. And we can do it kilometers either way. But you can see that not only are we in a complete mineral belt controlled by major companies, but we're only within several miles of existing projects. I'm going to use Matt Dorman to assist me in this presentation. Matt is study director. In other words, he led the team to put this together. working with Jerry Perkins, who's our Vice President of Development.
Okay, thank you very much, Yale. As Yale said, I've been involved with the management of the study. And on that, we've worked with some renowned international consultants. The lead consultant for the project is Jacobs Engineering. Jacobs are one of the biggest engineering companies in the world, as Yale said. They have about 60,000 employees. They had revenue last year of in excess of $10 billion. They've run a number of projects over 150 years. Mining in the area, geographically, Chile, Peru have included big mines such as Antamina, Tintaya, Radomiro, Collahuasi. So I think they have excellent credentials to have finished this study for us. Backing Jacobs up, we've used other internationally renowned consultants such as Knight Piésold for environmental work. We've used Schlumberger for water studies, and a number of others, all of which have great reputation in the industry. If we move on now, as Yale said, we've developed the pre-feasibility study for the Caspiche project. And let me explain to you a wee bit on slide 12 exactly what the mine looks like. If you look at the slide in front of you, you'll see down in the bottom right corner a round red spiral. This is the open pit. We're looking at taking out in excess of 4 billion tons of material from that open pit over 19 years of mine life. The material comes out by trucks. We try to minimize hauling costs because it obviously costs a lot of fuel to haul a truck uphill with 300 tons of material in it. So we put the crushers to break the material as close to the pit as possible. You'll see slightly above the pit, the process plant. This is the main concentrator, the flotation plant for the main ore body. And below that, there's a blue polygon called the leach pad. And there we have the crusher plant for the leach material. The process plant, the main process plant, will treat 150,000 tons a day material. This ore is hauled, as I said, from the pit into a crusher, conveyed, and then conventional technology to recover the copper and gold in the ore body. The leach pad, as Yale said, is largely used for the oxide material and other near surface material which is leachable. This in total will treat about 200 million tons of material over a 9-year life. Once again, typical treatment plant and operation for this type of operation. What we've adapted in the project is in-pit crushing and conveying. This really is no black art. It's a system of mass movement of material. As I said earlier, the project will move about 4.5 billion tons of material, of which 1 billion tons is ore and about 3.5 billion tons is waste material. To haul all that with a truck would cost in the region of 60 cents a ton. Using in-pit crushing and conveying allows us to crush the material to a slightly smaller size from the pit and then convey it with a conveying belt. That sort of system costs 18 cents a ton of material to move. The savings from the calculations we've completed with Jacobs and with the other mining engineers and using Sandvik, who are one of the major construction companies for building these types of systems, indicate that we can save something in the region of 25 cents a ton of material moved from the pit. And that equates to about 80 cents a ton of ore that actually goes through the process plant. The conveying system runs about 6 kilometers. You'll see going across in a diagonal from the bottom right to the top left, an orange corridor. This is the conveying system corridor. We take the material down to what we're calling the north stockpile, the waste. You can see in front of that an opaque area called tailings. This is where the discharge from the process plant goes once we finish processing and recovering the metal. We can use the north stockpile as the basis for the retaining wall for that tailings material. It gives the project a significant capex saving. We estimate with Jacobs that instead of building that wall to retain those tailings in a conventional manner, that is hauling it truckload by truckload for 6 kilometers, we can actually use a conveying system that we can save something in the region of $1 billion. And over and above that, as you can see, behind that tailings wall, you have a significant amount of material. There's about 2 kilometers of material behind that. And so the additional safety factor of having all that material behind a wall, rather than a wall that may only be 200 or 300 meters wide at its widest, is significant in a country that has earthquakes. The mine itself is reasonably compact, but we have the advantage of being on top of the hill in Caspiche. We're not in a valley. We have suitable and enough area of land to build the process, build the project, build the infrastructure that we need to get this mine in place. If we move on from the actual engineering layout of the mine into the actual results of the feasibility study, let's first talk about production of gold. We're looking at an average production of gold over the life of the project of about 696,000 ounces. And as Gilles said, when you look at the gold equivalent, that's about 1.17 million ounces of gold equivalent per year for 19 years of the project. There is a smaller project, as I said, the heap leach operation is there. That produces about 200,000 ounces of gold by itself, and of that total gold of 19 million ounces, about 2.8 million ounces is attributable to the heap leach. So at 200,000 ounces of gold per year in the early years of the project for the first 9 years, that's a significant cash flow benefit for the project. As we've said, we now have a proven and probable reserve. The proven and probable reserve is 30 million ounces of gold equivalent. That's basically made up of 19 million ounces of gold, 4.6 billion pounds or 2.1 million tons of copper, and around about 41 million ounces of silver. So it's a significant project, and for that we have to process at a very high rate. 19 years life, we're processing, as I said, 150,000 tons a day through the concentrator, and a maximum going to the heap leach of about 70,000 tons. So those are the production figures from the study. We look now at the financials. We're talking of a project of about $4.8 billion initial capital and around about $800 million of sustaining capital. That's capital that we'll need through the project life to replace or add equipment as we need it. The NPV at 5% discount is $2.8 billion. The return is 11.5%, which, you know, is significantly more than you're going to get in the bank today. And the payback is 7 years from initial production. And as I said earlier, we have a mine at the moment that will produce for 19 years. We have low operating costs when we consider the credits we get from copper and silver. It works out to about $18 an ounce of gold produced. Overall, on gold equivalent, we're talking about $600 an ounce of gold equivalent produced. Moving forward, people say, well, you know, how robust is this project? Where do metal prices have to go before the project breaks even? And if we look at slide 24, we can see copper price at $1.52 a pound, gold price at $1,024 an ounce, and an overall gold price of about $850 an ounce. So the project economics are very robust. There's considerable leeway between today's market cost for metals and what we can see before the project would actually only break even instead of making $2.8 billion. Moving forward, I mean, as you can say, okay, this is the first economic study being completed for Caspiche. It's the first step towards the logical development of the project. As Yale said, we have two projects in one. We're looking at the heap leach operation that will run for 9 years, and a concentrator or flotation plant on the main ore body that will run for 19. So what are we going to do? We've got an economic assessment completed at pre-feasibility study, and the company believes value can be added to this project by developing the feasibility study for the heap leach operation. You may recall we put out a pre-feasibility study in June for this same type of operation, which was about $300 million in capital and around $300 million NPV with about $1.2 billion of revenue. So developing that study, the heap leach study, first, as a logical development of the project, this material has to be removed as part of the overall project, is the next step that we'll be moving forward to. We're currently meeting with engineers to complete this engineering study, and we expect to kick this off in the second quarter of this year. This would probably take till late of the fourth quarter, early of the first quarter of 2013 to complete. In addition, we're doing the engineering peripheries, let's call them. We have to complete the geotechnical analysis to make sure when we build foundations for the plant that we're building them in the right place and in the right sort of material. We have to consider water on the surface, how we're going to protect the environment by ensuring that there's no contamination of potential rainfall or anything moving onto the plant. These are studies that are currently underway and will be completed late in this first quarter. We're also working forward on the environmental study itself, the impact assessment we expect to have to submit for approval to the Chilean authorities in the second half of this year. If we look now at the last slide, the development schedule, you can see what I've been telling you here. Our first step is to complete the feasibility study for the heap leach. At the same time, we'll be submitting the EIA for approval for the mining license for the project. And thereafter, we'll move forward with other project development. These are quite short terms. We're talking about in the next 12 months, significant steps forward for the project. And I think these, added to ongoing community relations that we have been developing over the years with the stakeholders, will be completed and will continue to allow us to develop the project on schedule. And with that, I think I'll hand back to Yale to give you the final roundup of the drivers and the why invest in Exeter. Thank you very much.
Now let's look at the value drivers for Exeter. The big picture is this project that we released today, the total project for Caspiche, is a 19-year life mine. And you'll see in the detail as we go forward just how much gold that produces. But that actually has two components to it. A 9-year project, which we call our heap leach project. The heap leach material being oxide material, the upper material, and some sulfide that has to come off to get to the sulfide, which is your copper dominant material. So there's kind of a project within a project. The 9-year heap leach project within a 19-year total project. The big study came out today, and it shows on the total project a net present value of $2.8 billion. It shows 11.5% internal rate of return. It shows these amazing revenues of $27.4 billion. But we had already, in mid last year, had the initial examination of what that standalone heap leach project could look like. Now, it isn't exactly the project that's come out at present within the study, because we have expanded the scope of the study that we had mid last year. But the study we did have showed relatively low capital costs, a net present value of $300 million for the project, $1.2 billion in revenues, and that was for what we could see as a project mid last year. So when you look at the value drivers, it is a distinct advantage to have a heap leach project that we can move initially forward with to be followed by the total project study. So we intend to take that heap leach project through to full feasibility study in 2012 and be submitting by mid-year this year this project to the government for environmental impact assessment approval. That's the last item on the page. We also have a view that we can drive further value for the project by optimizing the project. And what we mean by this is we have done significant work, but in the programs we've done, particularly metallurgically, Jerry Perkins, who led our study, sees potential for increasing recoveries. And when you look at a 19 million ounce deposit, okay, 10% of that is 1.9 million ounces. 3% of that, you can do the math, is something like 600,000 ounces. And if we can pick up even 3% recovery, which is a realistic goal in this, you're picking up a lot of ounces at effectively no additional cost. So we can continue to drive the value of this project going forward. To conclude, why invest in Exeter? Exeter owns really the largest pre-feasibility stage project in Chile that isn't already owned by a major. In fact, it's probably one of the largest pre-feasibility stage projects in the industry that's not yet owned by a major. Certainly in size, it's in the top 1% globally of gold deposits in terms of 30 million ounces gold equivalent. So as the undeveloped ones, it's in the top 1%. Chile clearly has low political risk. It's one of the most active jurisdictions for international mining investment. Many of the world's largest copper companies are domiciled there with operations. Certainly where we are, which we call the Maricunga region, is a strategic hotspot for transactions. There's been many transactions done over the years as the major companies and the junior companies see a path forward to develop these projects. Certainly Exeter provides immense leverage to the gold price. If you're of a view that the gold price is going higher, then having 19 million ounces proven and probable gives you exceptional leverage to that price. And we're clearly undervalued. The NPV in this presentation is 10 times what our current market capitalization is. When you look at the valuation, and this is the last slide of the presentation, when you look at the valuation, when I talk about transactions being done, it's always very difficult for me as the chairman of the company to say, this is what we are worth today, because it's in many respects a moving target. What price might you think the gold price will be at a certain time? I can't answer all those questions, but what I can say for a project like ours is that in the area where we are, in this slide you're seeing Caspiche. This is a chart showing Caspiche on the left, Cerro Casale, Lobo Marte, and El Morro. These names don't mean much to people, but they're the names of projects in the same region that have been bought by major companies. And in buying those projects, they clearly set a market price per ounce, which is usually the best way of looking at it. So if you look at Caspiche, on the left in pink, you see that we have our market capitalization, that's what that number refers to, is the market capitalization per ounce of gold equivalent that the company has. Then you take our complete market cap of the company, divide it by the ounces, you get 9. That's the value put on us by the market. But in blue, it shows how many ounces of gold we have, 19.3 million ounces, and gold equivalent, 30. In other words, the 30 is if you take the copper and byproducts and you give that a gold credit, as if you're saying, let's just call the copper gold, do a factor to get the ratio right. In fact, the project could be said to be 30 million ounces gold equivalent. Now, when we look to the right, Cerro Casale, in blue there you'll see 18 million ounces of gold were bought by Barrick in 2 different transactions. They bought 18 million ounces of gold, but because there's copper, there's a gold equivalent of 28 million ounces. And they paid, if you go through that math, $44 an ounce to buy those gold equivalent ounces. Look to the right again, Lobo Marte. Blue, 6 million ounces of gold. There's no copper there, so obviously the gold equivalent is still 6, and they paid $42 an ounce. Now this was a transaction done when Kinross bought it from Anglo and Teck back just after the credit crisis. And El Morro, bought by Gold Corp. You can see they bought 6 million ounces of gold, 18 million ounces gold equivalent, $34 an ounce is what they net effectively paid. So let's go back to us again. You're seeing our market capitalization as of today per ounce at $9. What was the difference in those projects? They're all large, but why are we 9 and why are those other ones higher? All of those projects are either at feasibility or pre-feasibility, and it isn't until today that we can rank our engineering status, if you like, in line with those. Today I can argue that the playing field is equalizing in terms of us being able to demonstrate on a technical and a financial basis what the value of the project is. So when we look at this chart and see the $9 market capitalization per ounce relative to the transactions that have been done historically between 2007 and 2010, that shows the opportunity for us to move, talk to the investors, the analysts, the entire financial community to show the value in not just Caspiche, but in Exeter.